Welcome to the Friday edition of Your Money, Your Call. It's bonds versus equities, and joining me on the panel tonight is Jonathan Katana, who is a principal advisor for Habitus Asset Management, and Adam Goldstein, who is from FIIG Securities, and they're here to answer any of your questions on anything. We can talk about whatever you like.
How are you doing? Thanks for having us.
Feel free to call us, 1300 30 34 35, and the email yourmoney@skynews.com.au. First time on?
Yes.
Seasoned viewer, let's start with you. Tell me about your business.
Habitus Asset Management, well, we're financial advisors focused primarily on direct investments within self-managed super funds or non-super environment.
Yeah.
And, you know, with the components of advice, we actually do focus on the actual delivery of the advice components as opposed to the product. So big difference. And, you know, been some massive changes, as you no doubt address in the coming minutes, but purely on financial advice.
And what's the reaction been like to because you're going to try, and we'll talk to the viewers about how you're going to try and change that business model, but in essence, being swamped with business at the moment, is that it's a very busy time for you?
It is, and I think some of the welcome changes, believe it or not, has been the FOFA changes that's come around, and I have to say, with these sort of financial reforms that have come through, we've actually found it to be quite refreshing, which we've been doing for quite a few years now in terms of actually just providing the advice and rebating all the commissions back to the client. So that's been pretty powerful.
Love that.
They all love that.
So let's just talk, Adam. You know, we've had you on before, and we'll talk a little bit about SPA in a second and FIIG Securities and how that's going. But do you want to talk to the viewers about what the FOFA changes actually are? You know, a sense of it, a bullet point. Because a few of the guests ring in and say, "Listen, you talk about these acronyms, and I don't have a clue what you're on about." So, FOFA was an attempt by the government to regulate some of the behaviour of all the people, you know, brokers.
What happened in 2006 when the previous government came into government? They instigated a whole lot of reviews, and coming out of those reviews, there was a Kipper review. There's the Bernie Ripoll, there was a whole range of things that were looked at, and essentially they looked at 3 or 4 different areas. One was the transparency of superannuation, one was the transparency of advice, and the marketplace in general. And it's about providing transparency. It was also about providing greater levels of professionalism, removal of conflict of remuneration structures and the like. And I think the changes have been largely positive, to be quite frank. And I agree entirely with your comments.
So as Jonathan's saying, you're looking to pay back some of the, you know, rebate the fees. Has that type of service been accepted by everyone, or is that still in a transition phase? So the fee structures are at this point in time not quite.
The financial services industry is not a homogenous group of people. Yeah. There are advisors doing, you know, from the very best to the very worst, as in any industry. Like, for example, we've been doing fee for service since 1998. When we started to get involved in SMSF, because you can't do SMSF advice without having a fee-for-service structure. So there are early adopters of this model, and there are still some that are still finding it very difficult to transfer.
So before we talk about FIIG Goldstein, can you tell me, you're the chair of the New South Wales chapter of SPA. So can you just talk a little bit about that, about what SPA is? And for the viewers at home, it's about the professional advice, isn't it?
Yeah, well, SPA is an acronym for the SMSF Professionals Association of Australia. It was established 10 years ago in 2003 by a group of advisors. And when I say advisors, I'm meaning accountants, financial planners, lawyers, actuaries, auditors, mortgage advisors, administrators. It's a very broad group of professionals.
How big is the membership?
At the moment, we're just under 3,000 members.
Yeah, right.
So it's been quite healthy, and we're still continuing to grow the membership base. But the best thing about SPA is it mixes these different professions together, and its whole focus is to increase professionalism and education standards for advisors in the SMSF space. Their leading product, I suppose, is their 2 specialist designations. So they have these specialist courses that are able to be undertaken. I don't know whether you're involved with SPA?
Yeah, I used to be, I'm sorry.
Sorry.
That's a fantastic group, absolutely.
So there's the SSA, which is the SMSF Specialist Advisor, and there's the SSAUD, which is a Specialist Auditor. So both of these programs have been delivered for some time. They're set at about a master's level, so they're quite significant. There's nothing easy about them. And they set the standard for SMSF advice in the marketplace, frankly.
Sure do.
Mate, with your type of customers, is it mainly SMSF type clients?
Yeah, pretty much, Mark. We tend to find And we're very cautious too. I mean, there's been a massive growth in the self-managed super fund numbers on a month-by-month basis. It's exploding through 500,000 funds. But is there I mean, before anybody opens up a self-managed super fund, the questions are going to be asked, is there a need for the fund? And so many times, a lot of these retail super funds can actually offer the same, without being able to buy direct property, of course, have been offered to actually go and sort of buy direct shares and do a lot of things you can do without having a self-managed super fund. But pretty much more and more we're finding, you know, obviously there's got to be a certain amount, but there's got to be a need for it. That's the first question that's got to be asked.
How do you get out to the clients? Like, how do you? I mean, obviously education is a big deal, and how do you get your message out to those guys? Is it through via, is it an advertising thing? Is it going to conferences? Like, how do the viewers get to hear what you guys have to offer? What's the best deal for you?
There's a lot of choice out there, and there's quite a lot of financial advisors in the country.
Yeah.
There aren't so many that come from the context of SPA and those who have been accredited with passed all the specialist educational requirements. But in terms of getting the message out, there's a lot of upfront educating and finding out if it's appropriate for the client. Because a lot of the times when you become a trustee of your super fund, you have to make sure that you're willing to take on that responsibility. Because at the end of the day, it's going to be ATO or another body that's going to come after you, and if you haven't done something correctly. So we always not scare the client, but we try to bring forward all the educational parts. So it's quite time consuming.
Getting them up to speed as to whether they should have a super fund or what they should do in it, or both.
Both, absolutely, because you've got to hold their hands through the whole process. And many a times there are clients who shouldn't actually, after they engage and start a super fund, they shouldn't be there.
Do you have many? I mean, you wouldn't have many because there's massive growth in self-managed super funds. We know that 670 a month, 500 billion. It's extraordinary numbers. But do you find you're often getting into a situation where you say, listen, you've read about it, you want control, but really you should be with a fund manager or with your work, program? Is that what you?
I'm finding that we're either winding down or not establishing more than we are establishing at the moment. And because we've been involved for a long time, all of our clients who should have them have already got them. And the phone calls that we get now are people that probably shouldn't. I fielded a phone call today from someone with $112,000 in an SMSF wanting to buy a property in Sri Lanka. And I'm going, whoa. Like, let's just have a conversation here about what you're actually trying to achieve here. So, I don't know. The good thing about it is that people are having the conversation at least. At least they're ringing and talking to someone about it, not just going and doing it.
Yeah.
So I think that's a good start. And quite frankly, I don't think people... the best person to look after your money is yourself at the end of the day.
That's right.
And so long as you're educated, experienced and knowledge and have an understanding of what you're getting into and what is required done, there's nothing wrong with doing that, just so long as you're up to speed, have some knowledge and have some education around this.
Do you feel there's been a compression on the fees naturally, so that makes it easier for people to set up a self-managed super fund? In that, I remember back in the day when I was a lot younger and I was thinking about doing that, and they'd say you need X amount of money because your auditing fees were so expensive, all these different pieces. But now you seem to be able to set up these things on the structure online, and then you go and get your planner. Do you think that compression is continuing?
Well, that's a dangerous tack to take, isn't it? I mean, when you get to those low fee, I hate to say it out there, but when you get to those low fee administration and auditing side of things, there's a lot of responsibility. You can go through and get them done for under $1,000.
$880.
There you go.
$880 for what? To get that?
To get
The
an
administration,
SMSF set up.
do the administration. So after you've set up the fund, you can set up a fund for probably the same amount of money, but you run into all the risk about the trust deed and all the rules that go with the fund and understand what you're doing. And many a times we come across trust deeds who've got borrowing within super that haven't been updated for 6 or 7 years.
So do they download a trust deed for $800 and then use it, and so it's not really capturing what my goals are? Is that what you mean?
Well, the trust deed is the rules of the fund, so it tells you what I'm allowed or not allowed to do inside the fund.
Yep.
So that's just part of the whole setup process, the educational side. I mean, you can buy anything from frozen cattle embryos right through to properties in Sri Lanka, but the advice that goes with it is paramount, and it starts right from the beginning, and the structuring of the self-managed super fund itself.
You'd agree?
Yeah, I just it astounds me sometimes. Like corporate trustees is a perfect example. We insist that every client of ours use a corporate trustee. And that alone is $800, let alone setting the whole fund up and getting the advice. So I just can't see how it can be done properly without going through the due diligence process.
Let's talk about what that corporate trustee means after the break. We'll go to our first ad break and we'll be straight back after a word from our sponsor.
A lot of banks try to seduce you with an introductory home loan rate. But at NAB, we say if it looks too good to be true, it probably is. Is it packed full of fees? Does your bank charge you for reducing the length of your variable loan? Will they stop you setting up a 100% offset account to reduce interest? At NAB, we're proud that for 4 years, no other major bank has offered a lower standard variable rate. Talk to your NAB banker or broker about a good, honest home loan.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
It's sale time at Jetstar.
With Jetstar's sale fares, enjoying everything the Northern Territory has to offer couldn't be easier. Fly from Melbourne Tullamarine to Darwin for $119, Brisbane to Darwin for just $129, or Sydney to Ayers Rock for just $125. Fares are one-way, checked baggage not included. Selected travel dates in 2014. Sale ends midnight Eastern Standard Time, November 25, unless sold out prior. Sale may be extended. Conditions apply.
To book, visit jetstar.com.
This is the reason there's never been a better time to purchase a new Mercedes-Benz C-Class. Zero. You can now drive away in Australia's favourite mid-sized luxury sedan with $0 deposit and a 0% comparison rate. And it includes sedan, coupe and estate models. All with zero. $0 deposit and a 0% comparison rate. So visit your authorised Mercedes-Benz dealer and get zero today.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Jonathan Catano, a Principal Advisor at Habitus Asset Management, and Adam Goldstein from SCEGS Goldstein. They're here to answer any of your questions. Feel free to call 1300 30 34 35 and the email yourmoney@skynews.com.au. We were talking about corporate trustees, individual trustees. I had to jump to a break. Always complaining about these breaks. Mate, tell me about the difference. Why do you always want them to have a corporate trustee? Why?
Well, the simple answer to that question is companies don't die. That's my simple answer. Companies don't die.
Right.
Let me give you an example. The reason why individual trustees are generally put in place is because it's cheaper. You save $800 or $1,000 setting up a company in the first instance, and sometimes you may pay less annual fees with your asset returns.
Yep.
But it's a couple $100, not a big deal. What happens with individual trustees is when one of the trustees dies, the remaining trustees left to be trustee for themselves, which
Right.
at trust law can't happen. So you've got a period of time, which is only 6 months, in which to replace the deceased trustee with another trustee. Now, there's actual cases around this where this has gone terribly wrong. If you're interested, there's a Katz v. Grossman case, which is K-A-T-Z v. Grossman. And
Yep.
what happened is Mr. and Mrs. Katz were individual trustees.
Yep.
I can't remember which
And what
Mr. or Mrs. died. Well, one of them died.
Everyone
And,
was upset. All got very disastrous. They
I'm
couldn't find a
pretty
friend.
sure it was Mr. Katz that died.
Right.
And Mrs. Katz put in one of the children as the replacement trustee.
Right.
Subsequently, Mrs. Katz also died.
Yeah.
So the one
And
son,
all the kids had a fight.
well, one son was left controlling
$1 plus superannuation fund. Now, as if you don't know this, super can't be left in your will. It's not something that is willable. It's not your asset.
That's right.
Yeah. So whoever controls the trust controls the money.
Right.
So what it eventuated was the money was distributed solely to the son, at the exclusion of the daughter, and it was a huge case. It's
For saving $800.
for saving $800. So you have these type of stories with your clients, and it's quite easy to convince them to have a corporate
You convince
trustee.
me.
It's easy
No
enough.
problem.
Easy
I
enough.
have no idea what
So you've got
I've
a corporate trustee at home?
I'll have a corporate trustee at home.
Well, you have one afterwards.
I will be, because I went to the kids. My wife will be very grumpy. Let's talk about, obviously, that saving money isn't a good way to save money, but you've got a way to save money because you've got a new product out. No, a new service. I've called it product. I shouldn't do that.
That's right, thanks.
So Jonathan's got a new service out. So talk to me what IMP Sydney is, and we'll pull up, hopefully, your website in a second.
Sure.
But what is it?
Well, simply it's a service, Mark. It's independent mortgage planners. It's just a service for anyone looking to refinance or acquire a new home, need a new loan. So Typically, a mortgage broker will receive upfront commissions and ongoing trailing commissions when they do a loan for anybody.
Yep.
What we're providing is a service where we rebate every dollar a broker will receive as commission back to the client's loan. So we'll charge them a fee for service, a fee to do the whole loan for them, use any lender in the country, and provide the whole service and rebate back to them 100% all commissions they would normally receive.
So you become the broker. So I want a mortgage for my property. I ring you up and I say, listen, Jonathan, how about that? And you put me into a bank, an organisation.
Right. Yes.
And that bank would have traditionally paid you some money.
Exactly. So
while I have the loan.
Correct. It can be anywhere from 0.4 to 0.7%. So if you've taken out your $1 million loan to put on a renovation in the back of your house, so normally it'd be $7,000. I would receive.
That's a very big. The back of the house is date.
I spoke to your wife.
My wife. Ignore Jonathan. Okay, so I go and get a mortgage, and then
that's right. So we would say, look, go to any bank or any financial institution out there and say, what's the best deal you've got? Then you come to us, and we can use the same provider.
Yep.
And we'll charge you a fee after we show you the savings you would receive by rebating all the commissions back to the loan 100%. So that ongoing trailing commission, for example, on a $1 million loan, the trailing to be $150 to $170 a month will go directly back on your loan. Right. So we have no interest in receiving commission, which is a general theme Adam and I have been talking about for a while.
On the face of it, sounds very good. We, for the viewers at home, we can't actually endorse any one particular product, but there's certainly a case to be said that a lot of the people that come on this show, you should take the time to click, www whatever. And we've had Aberdeen on, we've got you now on, we've had different companies come on, Mason Stevens, we've had all these people that come on. And I think one of the things that comes out of the GFC has been different quality of people would normally be in the arms of banks.
That's right.
And they never come out. And all of a sudden you now have access to these people that have got great skill sets, whereas everyone remembers the GFC where the quality wasn't quite there. The banks retained all the good staff, and now all these other people come out, and the quality's much better. If people get off, the chair and punch it into the website
and ask them questions. And look, Adam and I were actually saying before, like if you want a product, if you want an insurance product, just go to the bank. Yeah. Financial advisors are supposed to look at the whole scenario and say, well, what's your financial complexity that we need to solve? That's what a financial advisor is supposed to do.
We've got our first email for the night, and it's from Francis from Elizabeth Bay, and it's about the NAB CPS, which has recently been launched, and it says the prospectus goes out of the way to make it clear that they aren't deposits of the NAB. How are they different, and does it really matter, Francis? This email came in last week before it had launched, and for the viewers at home who the National Australia Bank put out a Tier 1 instrument. They were going to do $750 million, end up doing $1.5 billion at about 325 basis points over the prevailing cash rate.
90 day?
90 day. I believe that the level of interest in this was far greater than $1.5 billion. Everyone wanted to buy this. And I think that's around a timing issue. I think, I was talking before we came online, a lot of people would have got out of term deposits and bought equity, and now the equity feels very stretched, and that's why that's been quite popular. In terms of the risks, we did the analysis on those risks. I think there's an issue around new paper coming out at the moment. The regulator, APRA, wants to make sure that everyone is aware of the risks, so they over-accentuate, or they appropriately accentuate those risks. To be honest, if the NAB gets in trouble, where you sit in the capital structure is relevant, but you will end up with equity regardless. So that's the risk that you take. If you are in term deposits, you're in almost the safest part of the capital structure, and so that's very safe, but you get the corresponding return. Term deposits are what, 3-4%? It's tough life. At 3 and a bit over the cash rates, you'll probably end up with something closer to 5, and that probably works a little bit.
It's nearly 6 actually. Nearly 6.
It depends on, if we see some movement, it's a 7-year instrument, so if we see rates going up, you've been in futures markets and the like, you see rates go up quite quickly whether they realise it or not.
I think the best thing about this, though, is that I think, was it Frances? She's identified the fact that they've actually gone to great lengths to stipulate that this is not a deposit product.
Yeah.
And I think that's a really good thing for hybrids right now, because a lot of clients have been treating hybrids as quasi-term deposits, or treating them as at least a fixed income security, and the new ones just aren't that. So I think it's a great thing to say.
I think you need to be very clear on these hybrids. They're not easy to understand all the time. You need to be able to read, and some of these things have documents in them that says the lawyer will write, I'm prepared to pay the dividend, I'm prepared to pay the coupon, unless I don't want to.
Yeah.
And it's right down there, a little bit of paper. You go, hang on a second, when I read all that, that makes that a very risky instrument. So people don't really want to get that. Look, the sponsors call yet again. We have to go to another short break, but feel free to call 1300 30 34 35. We'll talk to you soon.
This is Jennifer Chen. She's a mum who loves buying toddlers' clothes at wootsiecutesy.com. Right about now, you're probably thinking, why would Jennifer be buying a quad bike called the Swamp Pig? ANZ's thinking the same thing. That's because we've got ANZ Falcon Fraud Monitoring. It can sense when a purchase doesn't look right, so you're protected. However, wherever you purchase, by credit or debit card, ANZ Card Security.
Hotels, robes and slippers. You look like a Persian sheik. To shake, Prince, whatever, you'll be rich like him too with our price match guarantee. Which means you won't find your hotel cheaper. And if you do, we'll refund the difference. Imagine that.
You know your dog is happiest when it's at its healthiest. So getting the right nutrition from their food is crucial.
That's why I recommend Optimum. Optimum combine proven science with the highest quality ingredients to ensure your dog gets real benefits from their food.
Put simply, Optimum provides your dog with the expert nutrition they need to get more out of life.
Let your dog show their full potential. Feed them Optimum.
Advilife, the latest product news.
Romsey is a significant rural holding in the heart of the Macedon Ranges. An hour from Melbourne CBD, Romsey offers vast potential for equine syndicates, owners, trainers and investors. Contact Nelson Alexander Smythe now for further information.
This isn't just a hospital, because it's much more than just wards, halls, smocks, scrubs and busy people. It's brilliant machines, reaching beyond these walls. Connecting doctors to hardware, to software, anywhere. Delivering better patient care wherever those patients are. Because a hospital isn't just in a hospital, it's everywhere.
Welcome back to the Friday edition of Your Money, Your Call. Joining me tonight on the show is Jonathan Katana, Principal Advisor from Habitus Asset Management, and Adam Goldstein from Skeggs Goldstein. They're here to answer any of your questions, and we have one from Kate. So we'll be talking to Kate in a second. Feel free to come on through, Kate. How can we help you?
Oh, yes, good evening. My husband passed away last year, and we actually have a superannuation self-managed fund of approximately $700,000. Yep. I was listening to your comments on the advantages of having a corporate trustee. When my husband passed away, things had to move fairly quickly, and I appointed a family member whom I trust implicitly and have a good rapport with as the second trustee. Listening to your comments, I'm interested into, apart from the cost involved, how easy or how difficult would it be to change from this family member to a corporate trustee, and what would it involve?
Kate, we're very sorry for your loss, and we'll be very happy to come up with some ideas on how easy it is. And I'm conscious of the fact that paperwork is such a burden to a lot of people. So it sounds like a pretty reasonable question. You know, how hard is it? Forgetting the $800 because we focused on that first, but Kate makes the point. What do you need to do? Is it chapter and verse? You know, give it
it's sad to hear the situation. These things are complex but easy at the same time. This is essentially an estate planning matter, and I would be encouraging Kate to speak to a lawyer that specialises in estate planning, number one. The reason being is that we need to make sure that all of her documents are speaking the same language. That's the biggest problem here. What the will says is different to what the trustee says, to what the corporation's law says with regard to the deed. Changing from an individual to a corporate is not a lengthy process. It will cost more money than what it would have done to do it in the first place, but still not a difficult process. The most difficult part of this is changing the names and the ownership of all the investments that are currently sitting inside the fund. Right. Because we need to be mindful that the corporate trustee or the trustees are the legal owner of the assets of the fund, not the members, not the individuals. It's the trustees that own the money. So the trustees become the actual owner on all the assets. So the biggest problem with this is
changing the names on bank accounts, the share portfolio, the benches, the bonds, the managed funds. That's the time-consuming part of the process.
So is it, and Kate's obviously listening but is not on the telephone, does it make sense in these environments just to put everything into cash, sell everything and then restart? Is that something that makes some sense because it's easy to change in cash, or at the time to...
You have to take each of these cases on face value and where you're at and where the portfolio is at and what the situation is. Again, I would just encourage Kate to go and speak to a lawyer who specialises in estate planning, and there are a few of them around that do this properly.
In the Gold Coast, does that mean?
Is it Gold Coast?
Yeah, it's Gold Coast.
Yeah, absolutely. Yeah, absolutely. So I can put in the right direction if she needs that
Kate,
assistance.
if you feel free, you want that sort of information, just send us an email to the email that we're constantly chattering on about, and I'll mark it to my attention and we'll make sure somebody looks after it. Does that sound like makes sense to you?
Absolutely.
Yeah.
That's right. Exactly correct.
And I think it's just about taking time. You don't have to do it straight away, but you do need to think about it and sort of work it on.
But that's why from the beginning of when you first have this first conversation about getting your affairs in order, it's so worthwhile just talking to someone about it and saying, look, no, you should be doing this, and that, and these are the reasons why.
But mate, that's the great problem. They don't know you. They don't know you. It's very hard to find people. There's good quality guys sit on the show, but there's a lot of people who aren't necessarily good quality. Yeah. And so one of the greatest threats I always see is having coffee. I want coffee to stop, because so many times you have a cup of coffee, someone come up with a great idea, I'm going to buy that share, or I've found the right guy for me. Don't you feel that that's the problem?
Well, yeah. Look, absolutely. I mean, more time needs to be spent trying to find someone. And many times when clients come in to see me, I say, look, this is your first time you've sat down with me. Go and see 2 or 3 other people. Go to the bank down the corner of the street. Good luck.
Couldn't agree more.
And go and get a bit of an understanding and understand what the delivery is, what the advisor is handling their complexity, just how that sits with them.
Do you feel that with the banking sector, and I'm not looking to bash the banks, do you feel it's hard for them to be able to get to that level of the quality of service? Just because they're too big?
Probably not the right question to ask me about that. I think Adam might be more tame than I would be.
I don't know the answer to that question. All I do know that if the banks got this together, it would be quite dynamic.
You say that of all the things with the banks. We can talk about them in a minute. We have to go to another short break, but please feel free to give us another call on 1300 30 34 35 and the email yourmoney@skynews.com.au. We'll be right back.
This isn't just a classroom, because it's much more than papers, pens, desks and diagrams. This classroom is really in a classroom. This is science shared. The best teaching the brightest, using brilliant machines to empower local industry to compete on a global scale. Because our most valued resource isn't our technology or even the resource itself. It's our people.
I want more than just a trading platform, competitive pricing and helpful service. I want it all. I want fully customizable tools and charting. I want fast execution in fast-moving markets. I want the complete trading package from a provider I can trust. You can have it all with CMC Markets, home of the active trader.
Out here, success is measured in fractions of a second. So pushing the limit requires a good foundation. Which is why our racing cars are based on our most dynamic sedan, the Volvo S60. Come and drive the S60 to see why we're taking it V8 Super.
If you've never seen Paul Murray live before, let me explain the show. It's about this long and everyone's got an opinion. Most of all me. You can be part of it on Facebook and Twitter and join us in conversation. I love a good fire up. Only on Sky News.
Holden, proudly sponsoring Paul Murray Live.
Welcome to the Friday edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Jonathan Katana, Principal Advisor from Habitus Asset Management, Adam Goldstein from FIIG Goldstein, and we haven't got an Englishman in the studio. That's all right, we'll find them soon. Feel free to call us on 1300 30 34 35 for any questions you have on fixed income or the equity market or the world of planners, or the email is yourmoney@skynews.com.au. Tell me, what trends are you seeing in clients, and I mean trends from an investment perspective? If I can start with you, Jonathan, what are you seeing? What are they looking for?
Well, look, 90% of my clients have invested in direct equities. 90% of them. So basically they've gone through the hardships of GFC and understand the story that we talk about and espouse in terms of industrial shares, living off the income of industrial shares. Yeah. So we don't care about the share price where it is. We don't care where Telstra's traded today. So we talk about the volatility of the assets our clients are in. Yeah. It's not an issue. They understand the long-term perspective where we are with good dividend-growing stocks. So it's not much of an issue at the moment. I mean, there was, I guess you could say... What's that, sorry?
It's all been going one way. Like when you think about it, the industrials have just been going, it's been a nice steady, sort of like 18 months.
Yes.
So they'd be happy.
Absolutely. So, the volatility, the cash rate is a different story though. We've actually had a cash rate crash, haven't we? Where we seem to be bottom feeding. Now I feel for those retirees and pensioners are sort of caught down this sort of low bar area, and they're caught there for a while, who knows how much longer, but it's quite a sting. However, fortunately for my clients, they don't sort of feel that.
What about you, mate? What are your clients mainly? What's the trends you're seeing in your guys? Are you part of the thing the RBA talks about? They're all buying property. The self-managed super funds are buying property. They're worried about that heating of the property market. I mean, is that what you're saying?
We haven't been largely involved with the property SMSF discussion.
Yeah.
I think most of we do have property in SMSF, but most of them are our business clients that are buying their commercial premises. Because our business is SME focused. So our typical client is a small business owner or a retired business owner, extracting their wealth out of their small business, buying their premises. That's our typical client. So it depends where they're at, what they're trying to achieve. If they're accumulating, volatility is their friend. If they're decumulating, volatility is their enemy. Yeah. So it depends on what side of the ledger they're sitting at this point in time. Sequencing risk is a disastrous thing. It destroys portfolios.
Do you want to talk to the viewers about what sequencing risk is? Because I was actually thinking about doing a whole show just on it.
You almost could.
It's unbelievable. So do you want to talk to them about what that actually means for the viewers at home?
Well, sequencing risk is essentially the risk of the timing of your drawdowns.
Yeah.
So, for example, and just very simply, if you had to sell your share portfolio and the shares were trading at $1 a share, and you had to sell 100 shares, that's a pretty easy equation to work out. But if your share portfolio dropped by half, all of a sudden you're selling twice the number of shares to get the same outcome.
Yeah.
So you're destroying portfolios that will never ever recover. They just won't recover.
So there's also that timing, isn't it? We talk about that volatility. If you are on the cusp of retiring, you have a GFC type experience of a tech bubble, whatever it might be, your capacity to recoup, you lose 50%. Well, it can't just be 50% improvement now. It's got to be 100% improvement to get back where you were. And it comes down with the escalator and it goes up.
And in the meantime, you're drawing down as well.
Yeah.
It's never going to recover.
So how do you get your clients to manage that? How do you get them to talk about that? What do they do? For us, you buy more fixed income. It's just as you get older, you buy more fixed income, so you have less concerns about that loss of capital because you're less likely to have it.
For our decumulating clients, our only focus is liquidity and cash flow. Cash flow is king.
Correct.
If you get that piece wrong, it doesn't matter how good your performance is, it doesn't matter.
Exactly.
It just doesn't matter because you're never going to recover what you had lost anyway. So our focus is making sure that we have set aside sufficient cash in a cash bucket to draw down their pension payments, a level of fixed income to top up the cash bucket when required, and some share portfolio, some income. So you look at that portfolio, very few people these days have enough capital given the income they need, very few. So we're drawing down from various areas over various times. So my objective is to, when equities have rallied, take some of the profits, top the cash up and keep the process going forward.
Yeah.
So managing sequencing risk is putting your clients in a situation where they don't have to draw down assets that have gone down in value. That's it.
Yeah.
If you can manage that process, you'll never put them in a bad position.
We'll just change step, and I've got to hold this up high enough. You talk about the cash flows and about the importance of having that capital stability. We've got this guide to fixed income. This is the second edition of that guide to fixed income. And for those people who'd like a copy of this, we'll deliver it next week because we've got them in the office. We'll take the first 20 callers who are kind enough to send us a letter. Don't just send me an email that says, give it to me. Why, Jen? If you could write us an email with a question that might pertain to your interest, we'll send the first 20 out and we'll send them a book. That'll be somebody's job on Monday, not mine. Low-hanging fruit in terms of investment. What do you think might be the low-hanging fruit? Because I feel, and we'll talk about the RBA in a second, I feel that equities are stretched, some of the credit gets stretched, property's moving. Is there a low-hanging fruit?
I don't think so at the moment. I think, with your financial markets background, every market's like an elastic band, isn't it? They expands out and eventually contracts back to where it feels more comfortable. At the moment, it just might be one of those patient times. And the media and the press are fueling this property side of things at the moment. You talk about volatility. And we've seen over the last month some of the biggest records in terms of sales in Sydney. It's just blown out of proportion. And I do believe, though, that some of the comments sort of reported by the Reserve Bank, it might be a little bit too early to do that because there's been a big supply issue in this country of property. So there's a great demand for it. And we're finding a lot of investors are racing back in the market with these low interest rates. That's what we've seen just in terms of property purchasing. But the shares probably time to have a breather, and just let things settle down for a bit. Because, the US market's certainly overheated, but it looks like it could go higher.
What's your thoughts on the low-hanging fruit? Is there any?
At the moment, we're trying to get some short duration debt. I think that's for us at this point in time, getting them 1 or 2% above TD.
How short a duration are you? For you, is it the 1 year, 2 year? Is that what you're looking at?
Well, no, I wouldn't go any more than 5. I wouldn't think. That would be my feeling. Or you look for some inflation link, or you look for some indexation of some description. And all that's giving me at the moment is just that 1.5% above TD rates, which is what clients are looking for because they're trying to rotate to their fixed income. My biggest concern at the moment is that this is a time period like 1994. We're sort of going to that era again. It's also the time period where the likes of ACR and FinCorp came out last time as well, and people are going to start jumping on this stuff too quickly. There's a plethora of stuff that comes across my desk now, and it's rubbish.
There is, this month, now we're on the 22nd or whatever we are, there has been almost $100 billion of bond issuance in the world. I mean, $100 billion. Normally there would be 75. It's the same with the IPOs. You see everyone's coming out with these now. There's some of it is a timing issue because the banks are coming out, borrowing money because they're in the reporting season. So you can make some allowances for that. But for those of you at home who are being told this is an IPO you should buy, this is a new issue, you really need to take the time to, ponder whether that's appropriate for you or get the advice.
How are you finding in the fixed interest market? Is the appetite? Oh, it's aggressive, of course. But has it picked up tremendously in terms of that appetite over the last 3 months?
I think the NAB CPS issue was a classic example of how the market is demanding, customers are demanding a fixed, consistent return. They forget all the stuff you read in the paper about the equity market and rotating, rubbish. They just want to know that they can get up and play golf, go to bridge, see their grandkids, and they know that the stipend they're going to get will be consistent. And that's not maybe not all their portfolio, but a large percentage that when their husband's punting on some little, Wolseley Parsons or whatever it might be, everyone's happy that they know they've got enough money to carry on doing what they like to do. That's the choice.
Well, cash flow and income is what we're all trying to achieve at the end of the day.
Yeah,
we're accumulating a bucket of wealth so that we can live on for forever and not have to work.
Yeah,
and that's about income, nothing else.
And I think the thing that's been challenging has been the way the RBA is handling itself. So we're moving 2.5% cash rates. The RBA is in a very difficult position where it could ultimately be at 2% without batting an eyelid, even though they're reluctant to do it. Because there's just no chance they're going to start selling the Aussie.
Well, they wanted to get their currency down. And
there's no way they'll sell Aussie.
The risk is they're going to start a property boom.
So what do you do then? If cash rates go to 2%, how do your clients live? I mean,
Well, they're living fine, actually, off the dividends. Absolutely, it has been for years.
Well,
so there we go.
Vast percentage of people.
So long as I already own them now, I don't have to buy them.
That's right. When you think of the size of the deposit market, you know, it's hundreds of billions of dollars.
Over 600 billion.
Yeah. So those people are now living on 3% cash.
That's right.
That's phenomenal.
So where's the trigger? How long do you stretch that out for? If you know, in terms of they just get on with this bottom fishing for the next 2, 3, 4 years. I mean. How much longer do they last?
If they go and buy an equities, it'll blow it out of the park. I mean, you know, there's just not enough. There's not enough assets to meet that demand, and banks would have to try and respond. But it's also all the industry super funds. It's all these people that buy term deposits because they need to be in safe haven assets, and their performance for their clients are going to be harder to perform because you know the underlying term deposit went from 7 or 8, 5 to 3. That's a challenge.
Yeah.
So, you know, I think it comes back to that education. You've got to be able to work out what your investments are and try and get 6%. I think it's...
And don't be afraid to take some capital growth. Like,
yeah, absolutely. You've got to have that.
There's nothing wrong with trimming capital growth.
No. We have to leave it there. We'll go for another quick break, but we will be back very soon after a word from our sponsors. Am I holding?
Yeah, look, I just...
This isn't just a hospital, because it's much more than just wards, halls, smocks, scrubs and busy people. It's brilliant machines, reaching beyond these walls, connecting doctors to hardware, to software, anywhere, delivering better patient care wherever those patients are. Because a hospital isn't just in a hospital, it's everywhere.
Romsey is a significant rural holding in the heart of the Macedon Ranges. An hour from Melbourne CBD, Romsey offers vast potential for equine syndicates, owners, trainers and investors. Contact Nelson Alexander Smythe now for further information.
Natural gas in all its forms is a clean, affordable source of energy that can fuel Australia's economy for decades. Australians recently voted for a government committed to new jobs and investment, the time to secure 150,000 new jobs that the gas industry can create, and $40 billion a year in new exports. Natural gas is our natural advantage. With the right support, it can secure a brighter future for Australia. ournaturaladvantage.com.au. Authorised by David Byers, APA Canberra.
This is the reason there's never been a better time to purchase a new Mercedes-Benz C-Class. Zero. You can now drive away in Australia's favourite mid-sized luxury sedan with $0 deposit and a 0% comparison rate. And it includes sedan, coupe and estate models. All with zero. $0 deposit and a 0% comparison rate until November 30. So visit your authorised Mercedes-Benz dealer and get zero today.
Let's shop small. Let's support the butchers, the bakers, the vintage dressmakers, and all those small businesses that do big things for us. Think big, shop small. American Express.
Well, joining me tonight is Jonathan Katana, Principal Advisor from Habitus Asset Management, and Adam Goldstein from FIIG Securities. And I'm Mark Todd from FIIG Securities. We're here to take any of your calls or your emails. The phone number 1300 30 34 35. The email yourmoney@skynews.com.au. We have our second email for the night. It's from Trish, and Trish writes, I'd like to ask the panel what they think of the Macquarie cutting off Sydney Airport. What impact will it have on the shareholders? Thank you. And because we knew we had this, I've asked both my learned gentlemen. They said no idea. That's not their bailiwick. I have a view on it in that Macquarie have, for the viewers at home, what happened was Macquarie owns, and I can get this slightly wrong, but you'll get the general gist of it. Macquarie owns shares in Sydney Airport. They, rather than sell the shares onto the market, they've created a vehicle which they can offload those shares. So Macquarie didn't want the asset on the balance sheet. They've moved it off to a particular vehicle. The market consensus is the people that will own those shares on behalf of Macquarie will be institutions mainly, and they will therefore dump the Sydney Airport shares, and that'll push the price down in the shares. You know, there'll be short-term volatility. I think I haven't looked at where I haven't looked at where Sydney Airport is performing, whether it's a 6% dividend, but at this point in time, my gut tells me that infrastructure assets are going to continue to be very popular. So I'm not saying this is the time to buy it, but it's certainly not the time that I would be joining the institutional sellers if there are some.
No, I tend to agree with you too, Mark, on that. I just think that this is the market's in a very high time. It's a wonderful time to acquire picking the market to move that off balance sheet.
Yeah.
And I think there could be a few sellers looking to toss it off as well. So
yeah. So that's
maybe
what they'll
better
do.
buying level ahead.
Yes, that's right. So you might have an opportunity to, if you've got shares, you might be able to buy some at a lower rate and average in. But
average down.
Infrastructure is so popular. It's because of what you guys deal in. It's the longevity issue. Your clients will live for a certain amount of time, and they need to have a regular coupon. Infrastructure just offers that.
And they can't retire now till 70, so...
Yeah, what about that? You're not going to retire until you're 70.
Well, I actually think it's...
that'll be a long time for me,
welcome,
trust
actually.
me.
I don't know if you know, but back in 1909, when the age pension first started, the pension age started at 65, but male life expectancy was 68.
Yeah, right.
So we're now 100 years down the track.
That's right.
It's still 67, 65 for your pension age, but life expectancy for male is now 80.
Yeah.
And female 85 and probably close to be 100. There's going to get a stage where governments can't afford to fund this longevity risk anymore.
Yeah.
So these are the things that have to...
I mean, that's what Challenge has been talking about. The government's got to come out with some sort of longevity annuity. I mean, and that makes a lot of sense. It's just, I find that without wanting to denigrate the government, because we're going to have somebody from the National Party on in a couple of weeks, a new member, and he's going to give me his views on what the government can do. But it is very hard to articulate that problem they've got, because everyone that it affects thinks it shouldn't be me. And Keating brings in the reforms for the superannuation, and so you've reaped the benefits, but at the same time, you don't necessarily want to think, I'm going to lose this pension. I mean, I don't think we're like France, where we're all going to go out in the street and, riot and burn things, but we will be quite annoyed.
Just so long as they address the other side of the discussion as well, and that is making sure there's incentives for older people to work longer, making sure there's really big thought around how people can release equity in the house properly, and maybe some different types of products. There needs to be some thought around that part, as well as focusing on this as well. So,
without making fun of this government, I don't think any government's got that skill set yet. I just don't think that they've got their head around what the products could be and how because there's so much protection required. I create a product, somebody abuses the opportunity, and then people end up, selling their houses for less than what they're worth, and that's a challenge. It needs to have that adult conversation with government, doesn't it?
Well, that's right. The previous government did something.
They did, exactly, absolutely. And if you talk about sequencing risk, you should talk about longevity risk.
Oh, that's
as you said.
That's number 2.
Exactly. I mean, in terms of you hit it right in the head. Then actually, in mid-50s, the average age was about 57. Excuse me, about 66, 67. So when you retire at 65, you drop dead 2 years later. Now, as females are 86, males are 84. Children born today will live to 110.
Yeah.
Everyone around this table, touch wood, will live into the early 90s. So you talk about that funding of 30 years.
I can't imagine being in the early 90s.
You'll be down there. I can see Jane looking after you down the beach.
Yeah, I don't know about that. She'll be kicking me out.
They say old age is not for wusses, and I can't do that. So.
Oh, okay.
Yeah, we're definitely wusses. Speaking about, we were talking about the French, offshore. Do your clients invest offshore?
No.
No? Don't like it?
Well, it's based there's so much diversification with industrial shares here in Australia and with the frankings, it's just great. So if someone talks about, look, you haven't got enough diversification in industrial shares, they're wrong. Because I can go all through the banks, I can go through servicing groups, equipment hires, I can go through all of them for the diversification.
I did a conference panel, and the people wanted to invest offshore. They just wanted to do it. And I'm saying that is nuts. You're not offshore. You don't know anything about it, and you've got foreign exchange risk. You've got all these different things. I'm about to ask you now, but anyway, I said that I just didn't understand. I didn't understand the benefit of doing that when I like to be close to the asset that I'm trying to manage. So I now ask you, my friend, offshore.
Yes, we do.
Yeah, of course you do. Why?
Well, I tend to disagree a little bit about the diversification in a number of ways. One is we don't have the industries here in Australia that are represented overseas. We haven't got any really substantial IT companies besides Telstra.
Yep.
We haven't got any pharmaceutical companies. We haven't got the exposure to some of the growth industries that are happening overseas. We just don't get that exposure to. I know we can diversify BHP and some of the larger companies that are working overseas, like ANZ Bank, for example, but it's still not quite the same scenario. And I do love franking credits as well, I must admit. But the other thing too is the international equity part of our portfolio has performed very, very well of recent times, and that's largely because of currency movements. Now, you can manage you can manage it with your portfolio at the same time, but a depreciating currency in Australia is a great thing for international assets.
Yeah.
And that's been where our clients have been cherry-picking of late to top up their cash accounts. It's been a great strategy.
And obviously that's the goal of the RBA. I mean, they're jawboning the currency, and then they hope to try and push it down. Do you think that's going to be successful?
Have they got the firepower to do that?
We've got 8 billion.
How much gunpowder they got?
The Japanese are going to buy 750 billion of securities in yen. So if you want to have a fight with those guys, and you've got 8. I mean, that's not going to happen.
And the Yanks are printing money at $1 trillion
billion a month.
$1 trillion a year.
Yeah. Look, well, it's time for another very short break. We'll be right back in a moment. Put the kettle on.
Put the kettle on.
Hello, Gregory.
You're one of those mannequin things.
Actually, I'm a metaphor. I represent the money this old chap is saving with his Eubank home loan.
With a low-rate U home loan, the rewards are real.
Perfect for both home and away. Massport barbecues have some fantastic exclusive features and are surprisingly affordable. Barbecue like a chef at home. Perfect pizzas, brekkie, kebabs, rotisseries, roast veggies, poached fish and more. And when you're away, the Massport portable barbecue is perfect for beach, camping or boat. Purchase any Massport 210 series barbecue and get a Massport portable for just $49. That's right, $49. Visit massport.com.au now and find out why it's not just a barbecue, it's a Massport.
Natural gas in all its forms is a clean, affordable source of energy that can fuel Australia's economy for decades. Australians recently voted for a government committed to new jobs and investment. Now is the time to secure 150,000 new jobs that the gas industry can create and $40 billion a year in new exports. Natural gas is our natural advantage. With the right support, it can secure a brighter future for Australia. ournaturaladvantage.com.au. Authorised by David Byers, AP Canberra.
This is Jennifer Chen. She's a mum who loves buying toddlers' clothes at WootsyCutesy.com. Right about now, you're probably thinking, why would Jennifer be buying a quad bike called the Swamp Pig? ANZ's thinking the same thing. That's because we've got ANZ Falcon Fraud Monitoring. It can sense when a purchase doesn't look right, so you're protected. However, wherever you purchase, by credit or debit card, ANZ Card Security.
Welcome back to the final segment for the night. It's Your Money, Your Call, the Friday edition of Bonds versus Equities. I've got Jonathan Katana, Principal Advisor from Habitus Asset Management, and Adam Goldstein, who is here from FIIG Goldstein. We're taking calls. Lines are open, and we've got our second caller. The caller is Mick from Melbourne. Hello, Mick. How are you?
Hi, Mark. It's just a question about tapering. I hadn't had enough, but still. I just kind of your thoughts on whether it's going to be later than March or so forth, because I just hear the market and so forth, and if probably the market has a different opinion or what it does, just what it is, but for myself, I can't really see it starting any earlier than that, because they just don't know themselves. And I've heard a few people sort of saying that, okay, we could try it out, but you can't try something out like that. You've got to get it right, I would have thought, and that's why I could not see it starting any earlier than March in that sense.
Yeah, right.
And your sort of feelings on it as well, I suppose. I'm just interested in what it is.
So did you hear Mick's questions? So I've got some thoughts on tapering, but shall I start with you, and have you got any views on it?
Well, look,
We've got a couple of minutes.
I mean, it's a real hard call. I mean, we have to wait for the new Federal Reserve Chief to come through and some of the scary thoughts are coming through. We're hearing. It's really hard to say. And so many people being burnt getting this wrong. Yeah. And I just think it's too early to call it. I think there's more time ahead of us to make the decision.
I think you should do a TNY taper now, Yellum. They missed their opportunity. They were going to start tapering back in October.
That's right.
And the market was ready for it, anticipating it, and they decided not to do it. They should have done it then. That would have been ideal for me.
So, Mick, I'm in your camp. I'm of the view that it will be out past March, and the reason I feel it'll be out past March is that they'll prefer to overcorrect than undercorrect, and by that the reason is I don't think they actually know how to do it. and they're looking around for some ideas on how to do it. And what they will do is they'll try this way to taper. The market is ready to hurt them. They'll say there's a sign of weakness and push interest rates up, and that will be very bad for their economy. And they know that. Everyone knows what the elephant in the room is, which is the fight around interest rates. And so they don't necessarily know what tool will work. So they'll try one, that won't work, they'll have a fight. They will ultimately win this, but they'll have a couple of different tools. It'll be a twist, it'll be hold to maturity. They will play with this pretty hard, and then they'll try and push these hedge funds in the way that they need to sort of win the battle. Because US 30-year mortgage rates, you're talking about 20-year mortgage rates in Australia, I think ultimately we'll have some because of the 20-year curve. But 30-year mortgage rates went from 3.4 to 4.5.
Big spike.
Mate, that is those. If you look at the regional banks in the states, they're getting belted.
Big spike.
They can't make any money. Gentlemen, thanks very much for coming on.
Thank you for the
show. You happy with that?
I love that, Mark. Had a great time. Thank you.
Thank you very much to our guests. There was Jonathan Katana, Principal Advisor from Habitus Asset Management, and Adam Goldstein from FIIG Goldstein. And thank you both to the emails and the phone calls. It's been great. Until next week, I'm Mark Todd from FIIG Securities. Have a great night. Go the Australians tomorrow. It should be fun.
The information featured in this program is